I have the CME Group delivery report right here in front of me. Let's look at the raw numbers because numbers do not lie. The exchange issued 1,168 delivery notices. That is 5,840,000 ounces of silver demanded in a single session. But if you zoom out just 24 hours, if you combine today's report with the massive spike we saw yesterday on New Year's Day, the total number of contracts standing for delivery in the first 2 days of the year is 3,446. Let me say that number again slowly so you can visualize the mountain of metal it represents. 3,446 contracts. Multiply that by 5,000 ounces per contract. That is 17,230,000 ounces of physical silver moved in 48 hours. To put that into perspective, the global mining industry produces roughly 800 million ounces a year. That means, in the first 2 days of the year, before most traders have even returned from their holiday vacations, the Comex has been forced to cough up 2% of the entire annual global production. This is not commercial hedging. This is not industrial flow. A factory does not order 17 million ounces of silver on a Friday afternoon. This is a run on the bank. This is a sophisticated, coordinated, and violent raid on the exchange's physical inventory. In this massive 5-part investigation, we are going to perform a forensic audit of this transaction. We are going to look at the issuer and stopper data to identify exactly who took the metal and who lost it. We are going to connect this event to the China export ban that went live this week. And we are going to look at the devastating impact this is having on the retail supply chain, where dealers are now sold out until March. The price on the screen is $72.82, but the price to get metal is much higher because the metal is gone. This is the story of the Great Drain. You have to ask yourself about the significance of the date. Why January 2nd? Why did the whales wait until the first 48 hours of the year to pull the trigger? Because, as of this week, the China export ban is live. The China wall we talked about in previous reports is now a legal reality. New regulations in Beijing have restricted silver exports to only 44 licensed firms. This effectively cuts the supply of swing metal from the east to zero. The sharks in New York know this. They know that the 39 million ounces sitting in the registered vaults are the last easy ounces left on planet Earth. They know that once those ounces are gone, there is no backstop. The Shanghai arbitrage window is closing because the metal can no longer leave China easily. So the Western banks didn't wait. They didn't dip their toes in. They smashed the buy button and demanded delivery of 17 million ounces instantly. They stripped nearly half of the available liquidity in 2 days. If this pace continues for another week, the Comex breaks. Mathematically, it cannot survive another 10 days of this pressure without defaulting or changing the rules. We are watching an inventory liquidation event disguised as a trading session. The most terrifying part of this report isn't just the volume, it is the intent. When you see 17 million ounces move in 1980, it was two brothers from Texas trying to corner the market. Today, it isn't a couple of cowboys, it is the banks themselves. We are seeing a phenomenon that signals the end of the suppression cartel. We are seeing cannibalization. The banks are no longer working together to hold the price down. The truce is broken. They are now eating each other to secure the lifeboats. When you look at the issuer and stopper data, the list of who sold the silver and who bought the silver, it reveals a brutal war taking place behind the scenes. Usually the banks pass the silver back and forth like a hot potato to keep the game going. Bank A sells to Bank B sells to Bank C, and nobody actually takes the metal out of the vault. It is a paper shuffle. But today, the music stopped and the potato was frozen. The metal stopped moving in a circle and started moving in a straight line. Out of one bank's vault and into another bank's fortress, one major institution was forced to bleed. One major institution was forced to vomit up millions of ounces of precious inventory that they desperately needed to keep. And another major institution, one that used to be their ally, stood there with a bucket and caught every single drop. This is what happens when a currency system fractures. The thieves stop stealing from the public and start stealing from each other. We are watching the breakdown of the gentleman's agreement that has suppressed silver for 40 years. There are no gentlemen left on Wall Street today. There are only predators and prey. And the prey is currently bleeding out on the floor of the exchange. Let's look at the registered inventory. The Comex releases a daily report on the silver stocks in their warehouses. There are two categories. Eligible is metal stored in the vault by private owners. It is not for sale at the current price, it is just parking. Registered is the metal that has a warrant attached to it. It is available for delivery to settle a futures contract. This is the for sale sign. As of the close of business this week, the registered category has dropped to 39.4 million ounces. In just the last 24 hours, we saw a net withdrawal of 2.8 million ounces from registered. And that is just the beginning of the settlement process for the 17 million ounces demanded. Now, connect the dots. If there are 39 million ounces in the window, and 17 million ounces were just bought. That leaves 22 million ounces. That is all that is left. At the current burn rate of 2 or 3 million ounces a day, we have less than 2 weeks of inventory remaining. This explains the desperation we are seeing. The banks aren't looking at the price chart. They are looking at the inventory spreadsheet. And the spreadsheet says, critical failure imminent. This is why the price is holding at $72 despite the volatility. The physical floor is rising because the physical foundation is disappearing. Interestingly, the market reaction on Friday was muted. Silver closed up $1.35. It didn't go limit up. It didn't explode to $100. Why? Because delivery is a silent killer. When you buy a futures contract, it is noisy. It shows up on the tape instantly. When you stand for delivery, it happens in the back office. The impact isn't felt until the metal actually leaves the vault and the seller realizes they can't replace it. We are in the lag phase. The raid has happened. The metal has been claimed. But the market hasn't fully priced in the fact that the inventory is gone. This creates a massive opportunity for the observant investor. You are seeing the crime scene before the police arrive. You know the vault is empty before the news reports it. While the retail traders are arguing about whether $72 is a double top, the smart money is backing up the armored trucks to the loading dock. They don't care about the chart pattern. They care about possession. So we know the metal moved. We know the volume was historic. But who exactly was fighting? Who lost the metal? And who took it? In part 2, we are going to name names. We are going to look at the specific data showing Deutsche Bank as the issuer and JP Morgan as the stopper. We are going to explain why this specific transfer of wealth signals a shift in JP Morgan's strategy from short to long. And we are going to look at the retail fallout. While the banks fight, the little guy gets crushed. We will examine the out-of-stock notices at the major dealers and why you cannot buy silver until March. The war is escalating, and you are in the crossfire. Before we move to part 2, I need you to do me a favor. Press the hype button. The algorithm tries to suppress this information because it scares the establishment. By hitting like, you force the algorithm to show this report to more people. You help us break the suppression. We are going to identify the bodies. If you are just joining us, we have established the crime scene. 17 million ounces of silver demanded for delivery in 48 hours. The vaults are bleeding. The inventory is critical. But a crime scene needs a perpetrator, and a crime scene needs a victim. In part 2 of this investigation, we are going to name names. We have parsed the stopper and issuer reports from the CME group. These are the public records that tell us exactly which bank stood for delivery and which bank was forced to deliver. The data reveals a civil war inside the banking cartel. For years, we assumed the banks were a monolith, a team, the cartel. But in a resource crisis, alliances crumble. When there are only a few lifeboats left on the sinking ship, the biggest guy throws the smaller guy overboard. We are watching JP Morgan and Citigroup throw Deutsche Bank overboard. We are going to break down this cannibalization event. And then we are going to look at the collateral damage on Main Street. While the banks fight over the 1,000-ounce bars, the retail investor has been locked out. We are going to show you the sold-out signs at SD Bullion and Kitco that prove the physical supply chain has snapped. The sharks are eating each other, and the retail investor is left with nothing but paper. Let's look at the combatants. Let's look at the issuer side first. The issuer is the entity that holds the short position and decides to deliver the physical metal rather than buy back the contract. Usually, banks deliver because they have excess metal. But today, nobody has excess metal. So, if a bank delivers, it is because they are being targeted. The primary issuer in this cycle was Deutsche Bank. They delivered over 3 million ounces of silver in a single day. Deutsche Bank has been the sick man of Europe for a decade. Their balance sheet is fragile. It appears that the other sharks smelled blood. Now, look at the stopper side. The stopper is the entity that buys the long contract and demands the physical metal. Who took the metal from Deutsche Bank? The report shows 2 massive names, Citigroup, and the king of the silver market, JP Morgan. Combined, these 2 entities stopped over 4.4 million ounces. This is a raid. JP Morgan did not buy that silver to hedge a position. They hold the largest physical stockpile in the world. They bought it to corner the market. They see the same data we see. They know the mines are empty. They know the Chinese export ban is real. So, JP Morgan decided to take the last remaining liquidity from a weaker rival. They drained Deutsche Bank to fill their own fortress. This is not market making. This is market taking. By taking possession of this metal, JP Morgan effectively removes it from the circulating float. They move it from the registered pile to the eligible pile. Or, more likely, they load it onto trucks and move it to their own private vault next door. That metal is gone. It will never be sold at $71 again. Why would JP Morgan do this? For years, the internet has accused JP Morgan of suppressing the price. And they did. They held massive short positions. But JP Morgan is not ideological. They are profitable. They suppress the price when they want to accumulate, and they squeeze the price when they want to sell. This raid signals a pivot. It signals that JP Morgan has switched from net short to net long on physical metal. They are finished accumulating. Now they are tightening the screws. By draining the exchange of 17 million ounces, they are forcing the price higher. They are front-running the revaluation. They know that silver is going to $100. They want to own the physical metal when that happens, not the paper liability. They are effectively cashing out of the fiat system and moving into the hard asset system. When the biggest bank in the United States starts raiding the silver vault, you know the end of the dollar is near. Now, let's leave Wall Street and look at your street. While JP Morgan was securing millions of ounces, what could you buy? Nothing. I have been monitoring the inventory feeds of the big three online dealers, SD Bullion, Kitco, APMEX. The data confirms that the retail supply chain has suffered a catastrophic failure. Let's start with SD Bullion, one of the largest volume dealers in America. As of 7 p.m. Eastern Time on Friday, their product page for the current year American Silver Eagle displays a terrifying message. Out of stock. But it gets worse. Usually, when they are out of stock, they give you an estimated shipping date of maybe 2 weeks. Tonight, the estimate says, next shipment, March. We are in early January. They are telling you that for the next 8 weeks, there is zero inventory coming in. Why? Because the U.S. Mint cannot get the silver blanks. And why can't the U.S. Mint get the silver blanks? Because JP Morgan just bought all the silver bars that the Mint uses to make them. The blue whale ate the feedstock. The Mint is starving. Now, look at Kitco. Same story. You go to their Silver Eagle page, and you don't even get a price. You get a grayed out box that says unavailable. They aren't even taking back orders. They have closed the order book completely. This is significant because dealers usually love back orders. It is an interest-free loan from the customer. When a dealer refuses to take your money for a future delivery, it means they are terrified that they won't be able to source the metal at any price. They are afraid of defaulting on you. So they are choosing to shut down rather than take the risk. And then there's APMEX. APMEX is the dealer of last resort. They always have metal because they charge the highest premiums. They are the true price discovery mechanism for the desperate buyer. And right now they do have some Eagles in stock. But look at the price. I'm looking at the live listing for a single random year American Silver Eagle. The price is $89.70. Let that sink in. $89. The Comex spot price, the price the banks are trading at, is $71. That is an $18 premium. That is a 25% surcharge just to get your hands on the metal. And that is for a random year scratched up coin. If you want a brand new, mint condition coin, the price is pushing $95. This is the bifurcation in its rawest form. JP Morgan pays $71 because they buy 4 million ounces. You pay $89 because you buy 1 ounce. The wholesale discount has become a retail tax. The banks have effectively fenced off the cheap silver for themselves and left the retail public to fight over the scraps at a massive markup. And do you know why the premiums are exploding? It isn't just greed, it is replacement cost. The dealers know what just happened on the Comex. They saw the delivery report. They know that JP Morgan and Citi cornered the market today. They know that tomorrow, when they call their wholesale suppliers to restock, the phone isn't going to be answered. Or if it is answered, the price is going to be $10 higher. So they are raising their prices tonight to protect themselves. They are pricing in the scarcity that JP Morgan just created. This is the trickle-down effect of a bank raid. First, the big banks raid the exchange. Then, the mints run out of industrial bars. Then, the dealers run out of coins. And finally, the premium shoots to the moon. We are in the final stage of that chain reaction. But I'll just buy generic rounds, you say. I'll buy buffaloes. Good luck. The premium on generics has jumped from $2 to $8 overnight. Even the junk silver, the old pre-1964 dimes and quarters that nobody used to want, is trading at a 40% premium over its melt value. There is no cheap silver left. The tide has gone out, and there is nothing on the beach but sand. So if you are sitting there waiting for a dip to buy, you're looking at the wrong chart. The paper chart might dip to $65 tomorrow if the banks decide to play games. But the physical price at APMEX isn't going to $65. It is going to $90, then $100, because the supply is gone. You cannot buy what doesn't exist no matter what the chart says. So the U.S. retail market is broken. The U.S. wholesale market is raided. But what about the rest of the world? Silver is a global asset. Surely we can import more? In part 3, we are going to look at the global drain. We are going to analyze the inventory reports from the Shanghai Futures Exchange. While New York was bleeding, Shanghai was hemorrhaging. They lost 46 tons of silver in a single day. We are going to connect the bank raid in New York to the export ban in China. It is a synchronized global event. The West is draining the West. The East is draining the East, and the middle is empty. Stay tuned for part 3. We are going to Shanghai. If you are just joining us, the picture is becoming terrifyingly clear. We have a massive raid on the Comex in New York, 17 million ounces gone. We have a retail blackout in the United States. Dealers sold out until March. But silver is a global market. To truly understand the scale of this crisis, we have to look beyond the Hudson River. We have to look across the Pacific to the engine of the world's economy, China. While the sharks were feeding in New York, a different kind of predator was active in Shanghai. The industrial base of China, the solar factories, the EV plants, the electronics giants, woke up to the new year with a singular mission: secure the metal. In part 3 of this investigation, we are going to expose the global synchronized drain. We are going to analyze the inventory report from the Shanghai Futures Exchange that just dropped. We are going to show you how 46 tons of silver vanished in a single Asian trading session. And we are going to explain the phenomenon of backwardation, the flashing red light that proves the physical shortage is real, immediate, and catastrophic. The West is raiding the West. The East is raiding the East. There is nowhere left to hide. Let's go to Shanghai. We just got the nightly inventory numbers from the Shanghai Futures Exchange. Remember, China just reopened today after the holiday, and the moment the doors opened, the vacuum turned on. The total silver inventory in the Shanghai vaults has fallen to 681 metric tons. They lost 46 tons in a single trading session. Let's translate that. 46 tons is roughly 1.5 million ounces. So on the very first day that the new export ban went live, the Chinese domestic market consumed 1.5 million ounces of its own stockpile. This confirms our worst fear. The Chinese market is panicked. The industrial buyers in Shenzhen and the solar manufacturers in Jiangsu are not waiting. They are looting their own exchange because they know the export ban means no new metal is coming in from abroad. And they can't get metal out easily. They are trapped in the cage with a hungry tiger. And the only food left is that 681 tons. At a depletion rate of 46 tons a day, the Shanghai exchange goes dry in 14 days. 2 weeks, that is the timeline. So look at the global picture. New York is bleeding 2.8 million ounces a day. Shanghai is bleeding 1.5 million ounces a day. That is nearly 4.5 million ounces of physical silver vanishing from the visible stockpiles every single day. And the mines? The global mining industry only produces about 2 million ounces a day. We are running a daily deficit of 2.5 million ounces. Every single day, the world consumes more than twice what it produces. The math is broken. The buffer is gone. We are literally watching the exchanges run out of product in real time. This explains why JP Morgan panicked. They see these numbers before we do. They have satellites watching the trucks in Shanghai. They have spies in the refineries. They saw the Shanghai drain starting this morning. They saw the Comex levels dropping. And they realized, if we don't grab the metal from Deutsche Bank today, there won't be any metal left next week. This wasn't a trade. It was a preemptive strike. They secured their supply before the Chinese demand could suck it across the ocean. The inventory data is the smoking gun. It proves that this isn't a speculation bubble. It is a resource crisis. The world is running out of silver at these price levels, and the repricing event is the only way to stop the bleeding. Now, let's talk about a technical term that sounds boring but is actually the most exciting signal in commodities: backwardation. In a normal market, the future price of silver is higher than the spot price. This is called contango. Why? Because if I buy silver for delivery next month, I have to pay for storage and insurance. So the future price includes those costs. But right now in China, the market is in backwardation. The spot price is trading higher than the future price. Why? Because the factories are screaming, "Don't promise me metal in February." I don't believe you. Give me the metal today. I will pay a premium to have it in my hand right now. This backwardation is the heartbeat of a squeeze. It is the market telling you that there is a physical shortage at the current price level. The trust in the future delivery mechanism has collapsed. Buyers would rather pay more today than risk getting nothing tomorrow. We are seeing signs of backwardation creeping into the London market as well. This inversion of the curve is rare. It happened in palladium before it went to $3,000. It happened in rhodium before it went to $29,000. Now it is happening in silver. The curve is screaming danger. Now look back at the West. Look at the Comex. The traders in New York are looking at charts. They're looking at the dollar index. They're looking at Fibonacci retracements. They have no idea what is happening on the ground in Jiangsu. They think silver is a currency. China knows silver is a strategic technology metal. The West is selling paper silver at $71 because they think it's expensive. The East is buying physical silver at $80 because they know it's cheap compared to the cost of shutting down a gigafactory. This is the great wealth transfer. Every ounce sold on the Comex at $71 is being sucked up, refined, and shipped to a Chinese warehouse where it will never, ever be seen again. We are selling our family silver to pay for cheap plastic goods. And when the vault is empty, we will realize our mistake. But it will be too late. So the vaults are draining. The curve is inverted. The East is hungry. But let's go back to the battle in New York. JP Morgan versus Deutsche Bank. Why did Deutsche Bank fold? Why did they deliver the medal instead of fighting back? And what does this mean for the solvency of the banking system? Are we looking at a Lehman Brothers moment for a major European bank? In part 4, we are going to analyze the solvency crisis. We are going to look at the balance sheet of Deutsche Bank. We are going to ask if this delivery was a forced liquidation ordered by regulators. And we are going to look at the 0.02% verdict. We will do the math on how much this raid actually cost JP Morgan and why it proves they are playing a game of Monopoly while everyone else is playing checkers. The banks are not friends, they are survivors, and one of them just got eaten. Stay tuned for part 4. We are looking at the body count. We have reached the final calculation. We have watched the physical inventory evaporate. We have watched the retail supply chain collapse. We have watched the sharks turn on each other in the wholesale market. But there is one final question that is flooding my inbox right now. It is the question every End the Fed channel is asking. Is JP Morgan bankrupt? Did this raid break the banks? Is the system insolvent? We need to be adults here. We need to put away the fantasy and look at the cold, hard arithmetic of bank capital. Because if you misjudge the enemy's strength, you will lose the war. In part 4, we are going to audit the bank war. We are going to do the specific math on how much this raid cost JP Morgan. We are going to look at the balance sheet of Deutsche Bank, the victim of this raid, and ask if they are the next domino to fall in Europe. And I am going to reveal the terrifying truth about the 0.02%. The banks are not going broke. They are going long. And that is much, much scarier. Let's run the numbers. Let's look at the risk math of today's transaction. JP Morgan and Citigroup combined took delivery of 4.42 million ounces of silver today. At the current spot price of $71 per ounce, what is the total dollar value of that metal? Do the multiplication, 4.42 million times 71. The total cost of the raid was roughly $314 million. Now, to you and me, $314 million is an unimaginable fortune. It is enough to buy an island, but to JP Morgan currently holds $1.65 trillion in Tier 1 capital. Citigroup holds roughly $240 billion. So let's do the percentage. $314 million represents 0.02% of their combined safety buffer. Let me repeat that. 0.02%. It is the financial equivalent of you buying a cup of coffee. It does not dent their balance sheet. It does not threaten their solvency. It does not trigger a margin call from the Federal Reserve. If you're waiting for JP Morgan to collapse because they had to pay $300 million for silver, you are going to be waiting a very long time. They have the digital printing press behind them. They have infinite liquidity. The dollar squeeze is a myth. They will never run out of dollars, and this is the most critical, but of the entire year. While the financial cost was negligible, the physical signal is deafening. If the cost was so small, if $300 million is just pocket change for Jamie Dimon, why did they do it? Why did they break the unspoken truce with Deutsche Bank? Why did they drain the registered vault to dangerous levels? Why did they risk creating a retail panic? Because while they have infinite dollars, they know there is finite silver. They raided the market today, not because they had to spend the money, but because they had to secure the metal. They know that the $314 million they spent today bought them 4 million ounces, but they also know that next week, that same $300 million might only buy them 2 million ounces, and next month, it might buy them nothing. This proves that the crisis is not about solvency. It is about availability. It is a physical lockout. The banks are effectively converting their worthless paper fiat, which they can print for free, into the only asset that China, Samsung, and Tesla are fighting over. They are swapping the fake asset for the real asset at a speed we haven't seen since 1980. They are front-running the inevitable revaluation. They are not the dumb money getting squeezed. They are the ruthless money doing the squeezing. Now, let's look at the loser. Deutsche Bank. Why did they deliver 3 million ounces? Deutsche Bank has been struggling for years. They have a massive derivative book. They have legal issues. They are the weakest link in the global bullion chain. It is highly likely that Deutsche Bank was short silver. When the price spiked, they got a margin call. But unlike JP Morgan, who has infinite cash, Deutsche Bank might have been cash constrained in that specific desk, or perhaps they just wanted to exit the trade entirely. So they vomited up their physical inventory to close the position. They gave away their lifeboats. Now Deutsche Bank is flat. They are out of the physical game. But JP Morgan is long. This consolidates power. The silver cartel is shrinking. It used to be 5 banks, then 3. Now it is basically 2. JP Morgan and Citi, and they are hoarding the metal for themselves. This centralization of physical silver in the hands of the strongest banks is a signal. They are preparing for a new monetary system. They are preparing for a world where he who has the gold makes the rules. They just took Deutsche Bank's seat at the table. We are watching a strategic pivot. For 10 years, the banks made money by shorting paper silver. They suppressed the price and collected fees. But that game is over. The Shanghai arbitrage killed it. Now, the new game is cornering the physical. They use the paper market volatility to scare retail investors out of their positions. Then they use their infinite cash to buy the physical bars that get dumped. They are executing a bait and switch on a global scale. They want you to think silver is risky. They want you to sell. Meanwhile, they are backing up the truck and loading it with 46 tons in a single day. Do not listen to what they say. Watch what they do. They are buying aggressively. So JP Morgan is safe. Deutsche Bank is empty. The vaults are drained and the retail investor is locked out. Where does this leave us for Monday morning? We are heading into the first full trading week of 2026. The ghost week is over. The real volume returns. In part 5, the final chapter of this report, we are going to give you the final verdict. We are going to tell you exactly what to expect when the Asian markets open on Sunday night. We are going to discuss the price target that the banks are likely aiming for now that they are net long. And we are going to leave you with the ultimate strategy to protect yourself from the bank war. You cannot beat JP Morgan. But you can stand next to them, and right now they are standing in the buying line. Stay tuned for part 5, the conclusion of the heist. We have reached the end of this forensic investigation. We have audited the 17 million ounce delivery. We have exposed the cannibalization of Deutsche Bank. We have documented the empty shelves at the retail dealers. And we have done the math on JP Morgan's solvent, yet predatory raid on the physical vaults. The evidence is overwhelming. The old game of paper suppression is dead. The new game of physical accumulation has begun. And the scariest part? The banks are playing the same game as you. They are buying, they are hoarding, they are draining. In this final chapter, part 5, we are going to give you the Monday morning verdict. We are going to explain why JP Morgan's shift from short to long changes the physics of the price. We are going to tell you exactly what to expect when the Asian markets open on Sunday night to react to this news. And I am going to leave you with the final strategy you need to protect your wealth. In a world where the banks are now your competitors for the last ounce of silver. The raid is complete. The vault is locked. Now, the price discovery begins. Let's finish this. For 40 years, we have called the banks the cartel. We accused them of suppressing the price. And they did. But why did they suppress it? To accumulate. You suppress the price while you're buying. But once you are full, once you have drained the vault and secured the supply, you have no incentive to keep the price down. In fact, you have every incentive to let it rip. If JP Morgan now holds hundreds of millions of ounces of physical silver, and they have closed their short positions, do they want silver at $71? Or do they want it at $200? They want it at $200. They want to revalue their new asset. This is the pivot. We are likely to see the banks stop fighting the trend and start fueling it. They will use their algorithms to squeeze the remaining shorts. The smaller funds, the industrial hedgers who were late. They will become the engine of the bull market. This is the moment where the smart money stops betting against the metal and starts betting on it. So, when you see the price rise next week, do not think the banks are going to smash it. Think, the banks are pushing it. They are riding the rocket they built. Now, look at the clock. It is Saturday. The markets are closed. But in 36 hours, the Asian markets open. What do you think China is going to do when they see this delivery report? They will see that JP Morgan took 4 million ounces. They will see that New York is draining. They will interpret this as an act of resource war. The West is securing the metal. This will trigger a panic in Shanghai. If we don't buy it now, the Americans will take it all. So I expect a violent open on Sunday night. We could see a gap up as Shanghai traders try to front-run the New York Open. They will try to widen the arbitrage spread even further. If Shanghai goes to $85, New York has to follow. The bank raid has poured gasoline on the geopolitical fire. I need to take a second to ask you for something critical. This information, the delivery numbers, the bank war, the retail blackout, is not being covered by CNBC. It is not on Bloomberg. They want to keep the public asleep while they drain the vault. Finally, let's talk about your position. You are holding physical silver. JP Morgan is holding physical silver. You are now allies. You are on the same side of the trade. But JP Morgan wants your silver too. As the price rises to $80 and $90, the banks will launch marketing campaigns. Sell us your gold and silver. High prices. Cash out now. They will try to convince you to trade your hard asset for their paper fiat. Do not do it. They are buying because they know the fiat is dying. Why would you trade the cure for the disease? Hold your position. Let the banks fight the industrial users. Let them fight China. You just sit there and watch the value of your savings explode. The premiums at APMEX, $89, are the real price. Do not sell for less than the street price. In fact, do not sell at all until the gold to silver ratio tells you it is time. We are nowhere near that time. So here is the verdict on the 17 million ounce raid. It was a heist. It was the day the big banks realized the game was up. They stopped pretending the market was liquid. They took the metal and ran. The vaults are empty. The retailers are sold out. The East is hoarding. The West is raiding, and the price is sitting at $72 for now. This is the calm before the revaluation. You have the data, you have the map. Now all you need is the patience. The metal is gone. The squeeze is here. Welcome to the new world. Subscribe